We're here in Monte Carlo for the Rendezvous de Septembre. For Best TV, I'm Richard Banks. And I'm joined now by David Sowrey, Managing Director, Acrisure Re International. David, great to see you.
And you too.
So, Acrisure Re describes itself as the fastest growing brokerage in history. Tell us a bit about how the reinsurance division has contributed to that growth.
We were acquired by Acrisure in March of 2018. And since that time, we've grown probably fivefold in terms of revenue. I think that's a combination of factors. I think it's organic growth. I think it's the investment we've put into the business, but it's also touching the synergies that we have within the group as well. An example of the investment is that since 2018, we've built a wholesale team in London, which has been very successful. We've added a capital advisory team run by Ben Canigaretna, which has really got traction now. And we also have a facultative team run by Ghassan Mansour. So we're building skill sets. We're investing in the business. In terms of synergies, I think we've barely scratched the surface. I think there's a lot more to come there. It's early days, but we continue to work on those and look to develop them. So I think it's a combination of those three factors.
Fantastic, thank you. So we're here in Monte Carlo, lots of discussion about the market cycle, where we are in the market cycle. It seems that no sooner do we get a hard market than people are starting to predict the end of the hard market. How sustainable are current conditions, do you think?
Well, I think I would break this down into two categories, being casualty and property. There's been a lot of talk, it's probably been the main theme actually this year, of casualty reserving 14 to 19 years, and whether casualty reserves for those periods for US casualty are robust enough. So there's a lot of talk about that. There's a lot of concern that they're not. I think to that degree reinsurers will be looking at that to sustain current trading conditions. I also think, however, you've got to look at the recent performance of the class of business, which is pretty strong. So that has to be taken into account. So if I were to talk about casualty, I would say probably where the market is at the moment is in the short term reasonably sustainable. And I think we're looking at something of a gradual change rather than anything that's going to happen overnight.
So typically a hard market is a great opportunity for reinsurance brokers to show their worth. Tell us a bit about some of your experiences in that field.
Yeah. Well, I started in the market in 1989. I was a graduate trainee at CT Bowring on the North American side of the business. And I remember Hurricane Andrew very well. I've been through hard markets and traded through them. I think as a broker, the best way to manage hard markets, 2 points I would pick out. Probably one is embellishing or really focusing on the value of relationships. So long-term relationships, sustainable relationships. What we really advocate at Acrisure Re is partnership. We like true partnership between our clients and their markets. And that enables you to trade through difficult times, hard markets. And I think that is an important thing to build in terms of relationships, as I was saying. The other factor I would say is that managing expectations as a broker is extremely important. Okay, so with clients, it's always very good to have an early conversation with them and talk to them about what you think the expectation of the renewal discussions or whatever it may be will be. And I think that keeping clients aware of that and managing those expectations, being honest with your client, is very important.
So in a hard market, one would typically expect to see formations of new reinsurance companies, and we haven't seen that. And I guess one of the outlets for ambitious underwriters has been MGAs. Tell us a little bit about the role of MGAs and their worth in current market conditions.
Yeah, it's funny you should ask that question, because the world really has gone MGA crazy in the last 5 or so years. But I think the model's changed slightly. I think historically MGAs have been smaller, more entrepreneurial businesses. I think now they're businesses that are being built with proper infrastructure, proper capabilities and scale as well. We've seen various examples of those, the likes of CFC and Nexus. We're seeing MGAs come in as well through a balance sheet combined model like Mosaic and Fidelis. But I think for me, the change is that those businesses, the MGAs now, generally are larger businesses. They have proper infrastructure, proper distribution, real underwriting capability. And and what we're seeing as a result of that is a real flight to quality, is what we're experiencing. So these bigger businesses are attracting capital, underwriting capital and capacity, which makes them sustainable. Okay, and I look at that and I see the capabilities they offer, and I think where MGAs are now, the larger ones, they're genuinely starting to compete with the balance sheet insurers. So I think the market has changed in summary, and there is more of a focus on the larger MGA. I can see why they want to be established and built. There is an entrepreneurial spirit in the market, but also if you look at the valuations that these types of businesses can attract, that also attracts underwriting talent into them.
David, thank you very much indeed for joining us.
Thank you.
For MBES TV, I'm Richard Banks.